Welcome to the Wyoming Women's Business Center webinar series. Today we're going to be tackling an issue near and dear to our hearts. Well, for some maybe not so dear, but financial statements and accurate financial reporting are a mission critical topic for small businesses. Your financial statements tell an important story for your business, but it's in a new language for some of us. So we need some tools to help us really discern the important elements in this story and help us understand the issues beyond just the bottom line of our income statement. Our presenter today is Waldo Smith. Waldo started as a microloan director for our organization this past January, and he's been such a great addition to our team. Waldo's going to tell you a little bit more about his background and his experience in working with financial statements. One housekeeping item is that this webinar is going to be recorded, so it'll be available online after we close today. It will also be taking questions during the webinar, so if you want to post those in the chat box down below, we can address those while Waldo's on those topics. So go ahead, Waldo, take it away.
Thanks, Kim. It's good to be here. Welcome, everyone. We're glad you joined us today. We're going to be talking about income statements. And so I've got a couple of objectives we want to reach through this presentation. The first one is definition of what is an income statement. We'll take a look at that, what makes up an income statement, what parts are a part of the statement itself, and how it can be used as a tool in your business. A little background on myself. I've spent 27 years in lending. 25 were in a commercial bank setting where I worked with primarily farm and ranch loans, but also for the last 15 years before moving to Laramie, I worked with small town Main Street businesses as well. And it doesn't matter if you're a mom and pop shop, if you're a farm or ranch, the information we're going to cover today is vitally important to everyone. Now, I can tell you that as a banker, every time I move to a new community and I joined a new organization or joined a new church, what have you, the first thing people ask is, what do you do? And when I said my job was a banker, you could see the light bulb go on. Oh, he handles money all the time, so let's make him treasurer of our organization. And so I don't have I'm like everybody else. I enjoy bookkeeping just as much as the next guy. But why do we need good records? Well, keeping accurate records and clear business financial records can, for many business owners, be the most difficult part of running your business. For most business owners, understanding the records is at best a struggle, and maintaining a clear set of records is vitally important to the success of your business. It's absolutely vital that business owners understand their financial position. You can delegate the bookkeeping to another individual within your organization or hire it done. But if you don't understand what is being said by the reports you're getting, then it's difficult for you to make accurate decisions as you go through your day-to-day business. So we're going to take a look at some basic bookkeeping tools to get started with. The first is a balance sheet. Now, I'm going to cover a couple of different items and then get back to the income statement. But a balance sheet represents a moment in time. It shows assets, liabilities, and net worth. Or in easier terms, what you own, the debt you owe, and the difference between them is your equity, your net worth, what cash you would have left over if you sold everything off and paid off all your debts. The topic of today's discussion is the income statement. It represents a period of time looking back, and it shows income, expenses, and profits or loss. The third tool that can be used is a cash flow. A cash flow also represents a period in time, but it can be looking backwards or it can be looking forwards. It shows a flow of cash through the business. The difference between the income statement and the cash flow statement is the cash flow deals strictly with cash, whereas the income statement also includes non-cash items such as depreciation and amortization. So looking at an income statement specifically, it's also referred to as a profit and loss statement, an earnings statement, or simply a P&L. Along with the balance sheet, it's one of the two main financial tools you use in your business, the third being the cash flow. And I've said before, the balance sheet reports assets, liabilities, and equity. The cash flow reports cash movements. The income statement gives the most important perspective, and that is the profitability of a business. So what makes up an income statement? It's, as I said, from period X through period Y. The first thing is the gross sales. This is the total number that comes in from sales of your service or your product. If you are a manufacturer or a retailer, you're going to have cost of goods. So you would subtract the cost of goods from gross sales to get your gross margin, which is your income for calculating most items. Then we move to the expenses. You've got sales and marketing expenses, which would include things like advertising, your utilities, that sort of thing. Research and development. Most small town or Main Street businesses don't have a lot of research and development. That's primarily a manufacturing type entity, but we have to include it in here. And then general administrative, this is your rent, your utilities, your telephone, all of that. Total operating expenses then is the total of these three items. We subtract them from gross margin to get the income from our operations. And of course, if you're making a profit, you're likely to have to pay income taxes, so we subtract that out to get the net income. This is the bottom line. For those of you who like a more visual representation of this, here's a pie graph. Sales minus costs and expenses equals income. So to help you understand this a little bit better, I've got an example for you. And so I'm going to switch to an actual income statement. This is not an actual business. This is a representation, just figures I threw together. But it helps demonstrate for our purposes today what I'm talking about. In this case, we have gross sales of $500,000. Less allowances and returns or cost of goods, or allowances of returns of $2,000. So our net sales is $498,000. We had a beginning inventory of $15,000. We bought $100,000 worth of goods. Our freight, getting it in, cost $10,000. Our labor for manufacturing our product was $60,000. We ended with $25,000 in inventory. So our cost of goods ends up being $160,000. That subtracted from our net sales gives us a gross profit margin of $338,000. And then here you can see the expenses that we had: advertising, bank charges, depreciation is included in this, employee benefits, payroll taxes, rent, wages, utilities. We end up with a total expenses of $158,550 in this example. That subtracted from our gross profit gives us a net income of $179,450. So this is a representation of the last year. Now, how does this help us? if we take a look at our balance sheet, I've got a balance sheet for end of fiscal year 2014 and a balance sheet for end of fiscal year 2015. You can see the cash changed, the inventories changed, receivables changed, property, we bought some equipment, our debt went down, and when we get down to the bottom, assets minus liabilities equals net worth or equity. We started the year with $50,000 in retained earnings, $10,000 in capital investment for a total of equity of $60,000. At the end of the year, we still have our investment capital of $10,000. We have retained earnings of $50,000 plus the $179,450, giving us accumulated retained earnings of $229,450 for a total equity of $239,450. This was a very profitable year for this business. So let's look again at what makes up the income statement. We've got cost. This includes manufactured items, raw materials, wages, overhead, or if you're a retailer, your cost of good is the cost you pay to obtain your inventory. All other business expenses are called expenses and are listed down below in the expense section. Income is the difference between two large numbers, the sales minus costs plus expenses. If your costs and expenses are more than your sales, your company shows a loss. If your costs plus expenses are less than sales, your company shows a profit. Income is not equivalent to cash on an income statement because of the non-cash items. Again, profit and income mean the same thing. They're found at the bottom of the income statement. Sales and revenues mean the same thing, and they're found at the top of the income statement. These are terms that are used commonly in bookkeeping or by your accountant. And it's good to know the definition of these terms so that when you're talking to your bookkeeper or your accountant, you can understand where they're coming from. The income statement summarizes and displays the flow again, sales minus costs and expenses equals income.
Waldo, we do have a question that relates to the income statement and some of the information that you've already shown. Can I go ahead and ask you that now?
Yes.
So I'm a small business owner. I'm a sole proprietor. I'm not paying wages outside of, to any outside employees. How do I recognize my labor and time in that income statement? Because I can't pay myself as an expense, can I?
Yes, you can include your wages as an expense, or let me go back up a few slides. Okay, so your wages can be included up here in expenses as a general or administrative cost, or it can also be shown down here under with the income taxes as an owner's draw. But whether you can classify it as an expense or as an item down below, it always is subtracted out of your net income. So the net income is what is left over after you've paid yourself, after you've paid all of your other costs, and it is the profit for the business. It's what you then would use in other calculations that we're going to get to shortly. But what you pay yourself is shown on the income statement in one or the other of those two places.
Okay, thank you.
All right, I believe this is where we were at. So your income statement and your balance sheet are linked. Things that happen on your balance sheet from one statement to the next are reflected on the income statement. I showed that with the changes in your cost of goods or your inventories. We're not going to get detailed, but if you have an accrual accounting system, changes in the accruals on your balance sheet from one balance sheet to the next are also reflected on the income statement. So they are interconnected. The income statement shows income. The income then goes into retained earnings, and they are increased on your end of your balance sheet. Business assets must increase or liabilities must decrease for the balance sheet to remain in balance. And I tried to find an example of that. Usually your balance sheet has your assets on the left-hand side, your liabilities and your equity or net worth on the right-hand side, and they have to balance out. They have to equal each other. The total of liabilities and equity must equal assets. So when you have income from your income statement, either profit or loss, it affects your equity position, which then means something has to change on the balance sheet for it to remain in balance. The income statement shows for a period the actions taken by the business to either increase its assets or decrease its liabilities. Okay, that's a lot of technical terms. That's the definition of a balance sheet, or an income statement. But what do you do with that once you have the statement calculated and you know it's accurate? There are 16 main ratios that are recognized by financial institutions that they use to identify the health and well-being of a business. And most of them apply to a balance sheet, but there are some that apply to an income statement and are calculated and derived from information off the income statement. And they are earnings per share, gross profit margin, net profit margin, return on assets, return on net worth, and debt coverage ratio. So let's take a look at each of these individually. Earnings per share. Now, this only applies to corporations that have shares of stock outstanding, whether it be a privately held corporation or a publicly traded corporation. Shares have to be involved. So sole proprietorship, a limited liability company, a partnership, they would not calculate this particular ratio. But in our instance, we were using a corporation, and if you remember looking at it, our profits for the year were $179,450. If we went back and looked at the income statement, that's our bottom number, our profit. And so, for example, let's say our corporation has 100 shares outstanding. So profit divided by number of outstanding shares equals the earnings per share. In this case, $1,794.50 per share. That is a very good return on investment. This is people wanting to buy stocks in your company would love to see this figure. If you are a private investor looking to buy shares of stock in a publicly traded company, this is one of the things you're going to want to look for, the earnings per share, and that tells you how well the business has been doing. Gross profit margin. This indicates how well you can generate a return at the gross profit level. So it covers inventory control, pricing, and production efficiency. You take your gross profits divided by your total sales, and if on our income statement our total sales was $500,000, our gross profit after we subtracted out cost of cost is $338,000. So we divide 338 by 500 and we get 0.676. The larger this number is, the better. It means that you're very efficient. You're pricing your inventory correctly. You're managing the amount of inventory you have on hand at any one time, and your cost of producing your goods or acquiring your goods is very low. The next one is net profit margin. This shows that net profits shows how much real net profit is derived from each dollar of total sales. This will give you an indication of how well you're managing your operating expenses. So you take your net profit or your bottom line profit. In our example, it was $179,450. You divide that by your total sales, 500,000, and you get 0.3589. Again, this is a very good figure in our example. It shows that for every dollar that you have in sales, 35 cents of it is going to profit. Return on assets. This is where you need your balance sheet and your income statement. Net profit divided by total assets. It measures efficiency of your business, how effective the business employs its assets to generate profit. So in our example, if we went back and look at our handouts, we had $179,450 in net profit. Our total assets at end of fiscal year 2015 was $190,000. That gives us a 0.94 return on assets. For every dollar you have in assets, you're receiving 94 cents in profit. That's probably an unrealistic figure. Usually you'll see this down anywhere from 0.1 on the low scale to 0.3, 0.4 on a high scale. Return on net worth is very similar. It's just net profit divided by the net worth of your business. In our example, it was 0.749. The higher this figure, the better. The lower it is, the more you want to pay attention to some things. This determines the rate of return on your investment. So for every dollar you have in net worth, in this example, you're receiving 75 cents back in profit. The final ratio we're going to look at is debt coverage ratio, and this one's a little bit tougher to calculate. You take your net profit and you have to add in any non-cash expenses. This would include depreciation, amortization, that sort of thing, and then you divide it by the amount of principal you have due on term loans, mortgages, equipment loans, auto loans, the principal that's due within the next 12 months. So in our example, we had $179,450 in profit plus non-cash, or in profit. We add in $10,000 depreciation for the year. We subtract that by $5,500 of principal due within 12 months, and we get a ratio of 34.45. Again, the higher this ratio is, the better. The lower it is, the more concerned you need to be. This ratio gives you an indication of your business's ability to pay its existing debt or to take on some additional debt if you have some equipment that you need to buy. Say you're a retailer and you need to upgrade your storefront or buy some display cases. This would indicate to you whether you have the capacity to pay additional on any new debt. So let's take a look at where these figures are coming from again. So here's our net profit, $179,450. We add back in our depreciation of $10,000. And we look at our balance sheet. We've got a mortgage of $45,550. It's not reflected here, but a lot of times you'll subtract out your current portion and it'll show up as a current liability. So for the example, I just used $5,500. And that's how I came up with the figures for our ratio.
Well,
so why?
We do have a question about ratios. I'm sorry to interrupt. So when you see, I mean, this is 34 looks like a really big number. And can we set goals for our ratios based on what we typically see in our industry? Do ratios vary between industries and what you'd want to see on someone's balance sheet? And where do we get that information?
Okay, that was my next step. So thank you for leading into that. This ratio, 34.45, is really unrealistic. That is way too high. You'll rarely, if ever, find an actual business with that good of a ratio. But all of these ratios, once you've calculated them, can then be used as a tool to compare yourself to other industries. There are others in your industry. One place you can go is to Dun & Bradstreet's. Now, not every business joins Dun & Bradstreet's and gets a Dunn's number. But if you do, you can get from them industry ratios to match your particular business. If you're a shoe store, you can get information on shoe stores. You could get it from the county basis. If you're a large community, you can get it for your community. So like Cheyenne, you could get information of like businesses in Cheyenne. County basis, state basis, you could do it on like the Front Range or Rocky Mountain region or nationwide. So you can narrow it down as close as you want to your competition, or you can get as broad as you want. If you don't care to subscribe to Dun & Bradstreet and pay their membership fee, you can also contact the Market Research Center through the University of Wyoming and obtain the same information from them. Again, you can do it on a localized basis or on a regional basis or a national basis, but you can take your figures and then compare them to other people in your same industry, your same business line, and see how well you are doing in relationships. The figures you'll get will be an average. So if you're above average, that's very good. If you're below average, it may give you some ideas on areas you need to improve. Did that answer your question?
Yes, thank you for addressing that. So if you have, I mean, if you could pick any one or two of those to really focus on, I mean, for you, when you look at loan applications, are there issues that really jump out at you more than others?
Yes, there are. The debt coverage ratio is one that we focus on when we look at applications for a microloan. Most of the applications we see are going to, this ratio is going to be down in the 1.5 on the lower scale, or maybe 1.3. It may be as high as 10.0 on the high side, but it's usually a very small number. This one is one we focus on pretty close. The return on net worth is a return on investment is a good ratio just for your personal use. Return on assets is good. I'd say your gross profit margin and your net profit margin are the most important to a business. That tells you how well your sales are going, how well you're controlling inventory. I can give you an example of a business that I dealt with several years ago. It was a plumber, and he was very good at what he did, had been very successful at what he did, but he did not pay attention to his bookkeeping very closely. He usually hired it done, and he would his inventory was just out of control. He had a large metal building that he kept his inventory in, and there was no rhyme or reason how he arranged things or stored things. So he would go in and look in one area and see, okay, I'm missing some fittings, some pipe fittings, and I can't find them here. So he went and bought some and brought them back. Well, then a week later, he'd be looking at another part of his shop and find pipe fittings, exactly what he needed, but he didn't know where they were. He didn't have a good inventory list that he could check to see, and so his inventory was always overstated. He always had more than was necessary, and his profit ratios were low as a result. Another indication of the one where we're talking about inventory control. If you are a retailer, say you're a dress barn, for example, and you have stuff from 2, 3, 4, 5 years ago, or maybe longer, inventory that you bought but hasn't moved, it's still on your shelves, hanging on your racks, that's an area that your inventory control is not very efficient. And so you're probably carrying more inventory than you should, and it'd be better just to either sell it at a discount or maybe donate it to Goodwill or something, but get rid of it and clean out, give yourself room for more current stuff. So those are probably the primary ones, your gross profit margin, your net profit margin, and then if you have any debt in your business, the debt coverage ratio is a good one to calculate to see how you're doing in managing your debt load.
You mentioned a little bit about loan applications. How does the Women's Business Center have a fund that they can loan directly from?
Yes, we do. We have we obtain funds from various sources that we try to maintain an ongoing pool of money available as applications come in. We review them, process the information. We take an application to a loan committee. If the committee feels comfortable with that request, we approve it, and then we draw the loan papers and use the money out of our fund to advance to the customer, the business, so that they can buy equipment, they can purchase inventory, they can do a limited amount of remodeling, or just pay expenses to get started. A lot of our clients are startup businesses and they have to pay for advertising, first few months rent, deposits on utilities, that sort of thing.
How would a business qualify for that program?
In order to qualify for a loan from the business center, one, you have to be a business in Wyoming, and two, you have to be not eligible for traditional credit from a bank or a credit union. Basically, you have to go to your bank and make an application. If they say, no, we can't help you at this time, then you can come to us and we would take a look at your request.
Well, thank you, Waldo. That's some great information. Would you mind going to your your contact information? That's really great, because you are available to work with people and answer specific questions if they have regarding their business plans or financial statements, or if they're interested in applying for a loan. I don't see any other questions coming in at this time, so we can go ahead and wrap it up. I will let people know that our next webinar is going to be on Wednesday, December 3rd. We're going to be talking about the essentials of a good business plan with Lisa Wagner, and she's a great strategist when it comes to small business planning and growing a small business. So hope to see you all then, and thank you for joining us today. Thank you, Waldo. We appreciate your time.
Thank you.